Welcome everyone, and thank you for joining our latest installment in our Coffee Break webinar series. I'm Scott Musial, a Principal of Treasury Strategies at our Financial Services practice. I'm here today with Jim Poteet, who's also a Principal in our Financial Services practice. This morning, we want to discuss with you the 4 specific decisions that Treasury management and commercial banking executives need to address as a result of the new Basel III requirements in order to develop a winning strategy. We are joined today by over 800 of our peers, and hope that you are indeed enjoying this with a nice cup of coffee, and if not, that this discussion itself will be equally stimulating. A quick aside before we start, everyone who's registered for this session in a day or two will receive a copy of the presentation and a link to the recording. And should you wish to ask questions, you can do so in the question box in the bottom right-hand corner of your screen, and we'll follow up with you directly when our session is done today. Getting back to our topic of Basel III, U.S. regulators have issued the final rules related to Basel capital and liquidity guidance, and many banks are well down the path of implementing the processes and reportings to ensure compliance. But now we find ourselves at a very critical point in this process. Business leaders are asking themselves, how do these Basel requirements impact my clients, my strategy, and ultimately the underlying value of my business? We want to talk to Treasury management and commercial banking executives today about planning for the post-Basel III environment. You want to maintain the value of your portfolio. You want to grow it and increase its profitability. To do that, you need to understand the impacts of Basel to you and your competitors in a tangible and practical way that you can act on. From our conversations with clients and from our own internal discussions, we've identified 4 questions that you need to ask yourself to form these strategies. Your answers will help inform the strategies. It'll identify the levers that you can control so you can own your own destiny in the post-Basel world. Not everybody on the line today has the sway or the relationships to influence top-of-house decisions about the values of deposits and relationships. You do have control over your business, and there's plenty that you can do there to have a winning strategy after Basel III. So Jim, what are the strategic questions that Treasury management and commercial banking execs must ask about their business?
Thanks, Scott. We'll hit those in a second, but to your point, we just can't stress enough that our transaction banking partners really have to understand the impacts of Basel and ask the right questions so that those tangible and practical actions that you were talking about can be taken and you can protect and grow your business, right? So now, based on the Treasury strategies work, both with our bank executives and corporate CFOs, many of whom are on our call today, we continue to recognize the answer to these 4 strategic questions is the key to managing in that new environment. And so I know you're all excited to find out what those questions are, so we'll just jump to them. The first one here, our little orange fella in the sea of blue, we really need to understand, do we have the right clients given the post-Basel III economics of our business? Not just do we have enough clients, but do we have the right clients? That's the key question. And so Treasury Strategies is routinely asked to help develop new models to ensure our banks can factually answer that question, not make assumptions or mere directional assessments about whether or not they have the right clients, but thorough and factually with science make that determination. And what we have found is that not in all cases do our partners have the available expertise or in some cases the resources to perform that analysis. And so our job is really to help them. So we start by asking the first fundamental question, do we have the right clients for our business? From there, we really need to understand how do we identify the vulnerable clients and protect them from leaving. So in the new environment, the new world, there's only going to be so many target-rich clients to go around, and we really have to quickly identify who in our portfolio might be attractive to our competitors and what can we do about that. So probably in the past, this question of vulnerability probably surfaced more frequently as it related to operational execution issues or perhaps, your ability to extend more credit. But now we've got to think about the new weak links perhaps in our chains and reinforce those. And Scott's going to talk about that a little bit more in a minute. The third question is really, how do we make clients more attractive and profitable to the bank? So we have a portfolio of clients today. Some may be very, very profitable. Some may be marginally profitable. And so how do we figure out who those borderline clients are based on the new economics and find a way to remedy that situation? Because it really behooves us to do that. Losing a client and having to go out and acquire a new one is far more costly than just working with an existing client. And we, feel like it's incredibly valuable to be able to create that win-win situation and to help continue to foster that advisory relationship that you want with your clients and that you want to try to position yourselves as being for them. And then lastly, the price is right. Are we pricing clients appropriately given their post-Basel III profile? And when we say pricing, it's more than just fees, right? You have rates, you have account structures, debt covenants. There's a lot of different levers that you can pull. And so the bottom line is we have to have a well-thought-out plan to holistically evaluate and drive that new pricing strategy. And once we have that plan, we've got to logically get that information out into the hands of our sales makers and ensure that their goals and incentives are linked to the strategy, and the relationship between the TMO and the RM is very well understood. So at a high level, those are the four questions. Do we have the right clients? Can we identify those vulnerable clients and find ways to protect them? Can we make the clients we have today more attractive and profitable? And does our pricing line up with the strategy that we're trying to drive home? So if we go to the next slide, we'll drill a little deeper into this question of the right clients. And as I mentioned a minute ago, our clients are asking us to help them reframe and construct and test some existing models that they might have in the new post-Basel III environment and do so under varying scenarios. And we're also being asked to construct some new models. Even banks that are very cash flush are asking these questions because they have to be absolutely positive that the mix of clients that they have produce the right outcomes for their business. And we also have to remember over the last several years, the corporations have gotten far more active in managing their cash. The technology that is available to them to do so has improved dramatically. And through our direct work with those CFOs and treasurers, we see their liquidity composition and their habits changing. Now, this could be good news or it could be bad news, but in either way, you have to know for sure what the answer is. And then as rates start to rise, which we anticipate, there's yet another factor which has to be considered. So with that in mind, we have to defend our positions. We have to deliberately define what client types we want and develop ways to attract them to our bank versus watching them walk down the street to a competitor. And so there's only going to be so many juicy apples in the barrel, and everybody's going to be fighting over them. So that definition for my institution of what a right client is also has to be very objectively defined. And we also have to look at and assess whether the segments that we used to focus on are still the right ones, or do we need to move away or find new segments to enter into. And then we have to mobilize around that, that segment. What Treasury Strategies is doing here in this particular case is designing those client profitability models and market attractiveness assessments and helping to accelerate those transitions to what the new client mix looks like, what the new segments look like, and helping to design programs to drive that sales effectiveness. And I think the bottom line here for everybody is that you have to deal with this situation regardless of where you fall in terms of the LCR compliance categories, whether you're in the full category or modified or perhaps fall below the threshold. The thought of just doing nothing isn't really practical, because the reality is your competitors are making adjustments already, and you just can't sit on the sidelines and do nothing. Your mix has to change to some extent, maybe not a tremendous amount, but it has to change, and you have to react to both what your internal needs are and what you anticipate your competitors down the street doing. And so we're trying to, as an organization, help our partners play much smarter offense with the new liquidity that's hitting the market today, and help them defend their turf for those clients that they know they want to maintain and are very important to the portfolios that exist in their environment today. So Scott, we've looked at and thought about what clients do we really need and how do we protect them in the market segments. What do you think that means for the more detailed plans that can be put into place and the products and pricing that's going to have to match up with that plan?
Thanks, Jim, and we're going to go on to the next slide to talk about the first point about defending your position. As Jim said, there's only so many juicy apples in the barrel, and you're going to get two lines of attack when we think about defending your position. The first one is what's going to be attractive to you is going to be attractive to a whole bunch of other banks that have the same business and asset profile that you do. And this might even get worse, because what we're seeing from regulators now is they're pushing towards an increasingly standardized approach to LCR. The mode and method of interpretation is going to be standardized, which means that even questions of do I want a Macintosh apple, do I want a Honeycrisp apple, is just going to be one. So you're going to be in a bucket of banks that are all looking for the same clients. So that's the first level. I think that, and that's something that's easy to understand pretty easily, and it's day to day. The other level is that what we're seeing now is the uneven playing field. So we talk about clients. Certain clients are going to be attracted to you at a certain price point, and maybe even a certain service combination. But there will be other banks that don't have the same requirements that you have, that client can be attractive of a different area. Other banks have the ability to be more aggressive, to bring more things to the table to go after that client that you may not want to do. So what are the tools to respond to this? The first one is making sure that you have that strong attrition management program in place. We've worked with many banks in the past and work with banks today to set up that program where you can look at historical trends to start identifying clients maybe 3 months beforehand to see where the threats are. You know, on top of that, there's a strong governance on how you treat those threats and how you approach them. And the critical piece here is to have that in place, but also layer in that Basel framework. You need to take a step back in terms of how you value that client. And then the next one is honing your approach to defending those marginal clients that we're talking about. You need to know your boundaries. You can go to great lengths to keep a client there, but at the end of the day, if that economic equation is upside down, then you really haven't helped yourself out. So you need to know what you can and cannot do to keep a client at the bank. And even though it's kind of a brave new world to think about, understand where you're willing to let a client go. Also, you need to brush up on your value prop. You know, it's mom and apple pie banking. How do you move that conversation away from pricing? If another bank has the ability to be more aggressive in a certain way, how can you bring the conversation back to what you can really do for your clients that maybe that other bank can't? And finally, being smart about deposit pricing. Over the years, we've done lots of deposit models based on corporate treasurers' behavior. And this is not a market like money funds where you see a move of 5 basis points and you can just watch the money go back and forth. What we've observed in the past is that corporate treasurers are looking at the hard dollar impacts of changes in rates. And we can help you, through that modeling, understand what the band is. You don't have to be a market, and you don't have to be above market. In fact, that may hurt you. But you can stay within that band to keep that client there and keep them happy. Moving on to the next slide, we want to shift the conversation a little more to keeping those clients profitable. And as a baseline, we first want to understand that you're getting what you want from those clients. Knowing who the clients are is half the battle. Getting them in a valuable position is great. The next level is knowing what else is out there. We have extensive benchmarks to help you understand what the wallet is and what you should be getting for that wallet. So you can push that question deeper and deeper and deeper. Not just what's good for my bank now, but what should I be getting? And that turns into a next product sold analysis. What are the products that I can go to my clients to help solidify their position at the bank, to help entrench them at my bank? The other is something we like to call deposit engineering, which is a scary concept. Not something you want to go to a client for, but it's really getting down. You need to make pricing decisions at a holistic, but at a client level. There are lots of levers that you can pull to get a client happy and also in a place that you want them. You can restructure collateral agreements, you can just change prices, or you can work with their deposit structure so it keeps them happy while maintaining their value to the bank. You can also give them access to off-balance sheet options if that's going to help it. But what needs to happen is that needs to happen on a client level. So you need to support sales or maybe set up even a specific sales team to have those conversations, and we've seen that. Some of our larger clients have gone out to their clients and said, we need you to be at this mix, so we still want you, and it's been a successful program. We can help you through that. And finally, the last question, pricing strategies. We've talked a lot of deposits and liquidity, but this is really the holistic view of the client, service fees and deposits. And the idea here is that you want to correlate services and service combinations to operating balances. And this is something that we do for our clients and have done successfully in the past. And you want to align your pricing strategy against the value that's brought into the bank. If you can identify the services that can reasonably bring in account balances, operating balances, you can have a softer pricing position. But the other ones you can't. You can identify the places where you need to get those fees out of the client to make them valuable to the bank. And then the next level is identifying the service combinations that solidify the balances at the bank. Again, we're talking about finding good ways to keep your client happy and keep them entrenched in the warm hug of your bank. And we can do these, as I said. And this is not an academic exercise. Wrangling billing data and deposit data is what we do best. I can say personally, I probably dream more about account analysis data than I'd really admit in polite company. But this is stuff that we do and we love to do. And the benefits ultimately is you know where you need to capture fees from clients and you can price accordingly. You know what service combinations you can call that to your clients to keep them at your bank. So Jim, how should we wrap this all up?
Thanks, Scott. I think it's blindingly clear, right, that there is a burning platform for action. And if our calendars and immediate initiatives as bank executives in the transaction banking space don't reflect that fact, then we've got to change what our priorities are. What Treasury Strategies is in the market to do is coach and help our partners to understand what is your Basel III framework specifically for your institution. What direct implications do you have? What indirect implications do you have from your competitors? And what are the appropriate responses to be successful long term? We absolutely have to answer those 4 questions. Do I have the right clients? How do I protect them? How do I improve their profitability? And how does my pricing strategy support my full Basel III strategy? And then certainly, we'd be remiss if we didn't say you really ought to be talking to Treasury Strategies about this. We have a very, very long history of deposit strategy engagements. We've worked with 15 of the top 20 U.S. banks and many of the global banks. We certainly have an intimate knowledge of the TM business and its growth levers. That's what we're all about. We're not a general consulting firm across any discipline. We really are focused on treasury, liquidity, and payments. We have deep expertise. And it's not only on the transaction banking side, but again, also with our corporates as we talk to the CFO chain of command about how they position themselves and run their treasury business. And then we really bring the science alongside the art. It takes both pieces. It takes both pieces to be successful, but we really bring that science and that deliberate methodology to the table and that rigor to help ensure that we're scientifically getting to the right answers. So on the next slide, you'll see two handsome gentlemen there. That's Scott Musial and myself. We really appreciate your time today and for you spending your coffee break with us this morning. We are here to help. We'd love to hear from you and talk to you about the situations that are going on inside your organization and what we can do to improve those for you. And we also want to put a plug in for our next session on April 16th, where we're going to spend some time talking about the recent enforcement actions and fines related to KYC and anti-money laundering. And we're going to have some really creative and bright guest speakers who are going to talk about the shift that's occurring with the regulators and the fines and the way they are approaching the situation today versus maybe they did in the past. So again, we really want to work with you. We appreciate your time and hope you have a great day. Thanks for joining us.